Here's an explanation for essential question number one, the accounting one. And this should be from the fall of 2011 on about November 2nd. So what we're dealing here is a firm which has heating equipment installation business. Okay, so that's nice. Let's get to question number one, which we're going here in blue. A delivery of new ductless heat pumps is made along with an invoice for you to pay. Now please note what it is that you're doing installation. So these ductless heat pumps right here are actually going to be thought of as inventory for you. And so what you have is an increase in assets. Those are current assets. It's the inventory that you're looking at there. And at the same time, you have an increase in your liabilities. That's what the invoice is. You have to pay somebody else. You owe somebody extra money. Following through with the way that we usually think of that balance sheet, it balances. Your assets are equal to your liabilities and owner equity. And this increase in liabilities was supposed to be the same thing as your increase in assets. Now, please note that while it looks like no cash is changing hands, if you pull this apart, you saw that what happened is that you would have bought those ductless heat pumps, and that would have been a reduction in cash, would have been investment. Well, at the same time, you were borrowing money from your supplier. That's an increase in cash from finance. So let's go ahead and switch to a little bit of red and go to question number two, which is you decide to give your employees a raise. Well, that increases your expenses, and that will go ahead and decrease your net income, so you'll see a decrease in cash from operations. And that's kind of the easy one. Anytime you see net income moving around, you know that it feeds all the way over and should have an effect on cash from operations. So let's go ahead and switch to yellow for a bit and go to question number three. You make a payment on a loan your company took out last year. Well, payment, that's supposed to be some cash, and it's going away. At the same time, your liabilities are decreasing. Balance sheet balances, and that's the way of thinking about it. You're exchanging some of your liabilities for cash. At the same time, you see a decrease in cash from finance. That's where it goes when you pay things off. Switching colors again to green. Customer pays his $1,500 bill for work you completed. What that means is that you had an accounts receivable. That's a kind of asset, and that accounts receivable is going away. But at the same time, you are going ahead and getting another kind of asset, which is cash that's coming out. So altogether, what you have is your balance sheet actually balancing in your balance sheet. Now, please note, you got paid. So what's happening is that you're getting cash that's flowing in. Now, what it is that you borrowed money, or rather, you lent somebody to somebody else, so you had an increase in cash from finance going around right there. That should be one of the answers. You probably get away with having an increase in cash. Net cash flow is probably a fairly good answer too. So again, let's go ahead and switch colors to black. For question 5, sell some old equipment. So what we're looking at here is a decrease in some equipment which is supposed to be a fixed asset, an increase in a kind of current asset, and this is supposed to be cash that's coming in because you bought or sold an asset. So it's going to be in the investment section, cash coming in, positive number, just like that. Switch colors to a bit of orange. And what we're looking at here is buy a new flatbed truck for the company with cash. So what you're going to see is an increase in one kind of asset, that's the truck, a decrease in another kind of asset, which is cash. And please note, once again, you're balancing fully over there in the asset section, but at the same time, you're losing cash from investments. So that should be a good answer to 6. And let's go ahead and switch over to light gray for question number 7. Manufacturer of your most popular furnace brand raises its prices, so you pass the whole increase on to your customers. So this one's kind of tricky. What you're seeing is an increase in expenses, and at the same time you're seeing an increase in revenue. And what I'm guessing is this is kind of a push right here in net income. You could have like an ambiguous effect, in which case whatever you did over here, whatever decision you made for net income, just make sure that it's reflected over here in cash from operations, and you should be A-okay. And then the final question, which we'll go ahead and put in purple, is to borrow $1,000 cash for personal use from the business. Oh, this ends up being complicated. So what we have here is a decrease in assets, which are cash, a increase in another kind of asset, you're basically giving out this little itty bitty loan that's right there, and you also have a decrease in cash from finance because this is about borrowing and lending. You may think of it as maybe fitting into owner equity, but really is it says borrow and not just take out. So I think that's probably the right answer, even though I'm pretty sure that a decrease in owner equity would probably be acceptable to Adam when he grades these things. Anyway, good luck, and we'll see you again for the next quiz.